If you look at the U.S. equity market currently, the long-term historic average has been 16 to 17 times earnings for the S&P 500 going back the last 20 years. But currently, we're at levels much lower than that. Meanwhile, you have a U.S. housing economy that's recovering. We're currently only building 800,000 homes per year, and the normal demand, housing formation, is 1.5 million. So we're underbuilding demand. Secondly, the banks. These companies have been recapitalized with much stronger balance sheets, which allows them to lend to businesses and consumers, which will spark job growth. We think the overall unemployment rate is going to continue to tick down. And you've got, within this index, globally diversified businesses with revenues around the world. So U.S. equities look cheap. You've got a recovering U.S. economy. Looks like a great formula for investing. The process that we use is a 7-step research process. First step is a competitive advantage. Second step, the growth drivers. Third, an industry analysis. Fourth, a financial statement analysis. Fifth, management team assessment. And sixth, which is the most critical step of them all, it's a range of values analysis. It's 4 discounted cash flow models: best case, base case, bear case, and worst case. And we've been doing it the same way for the last 10 years, and it allows us to buy stocks when they're discounting a bear or worst case scenario and sell them as they get to the base case. So it's a very repeatable process. The last step is step 7, where we look at the risks and make sure to measure any large quantitative impact to our base case values. So this process, we've been using it for 10 years. It's repeatable, consistently applied, and this has led to our performance historically. Amazon.com. This is a company with a very strong competitive advantage as it dominates e-commerce. It focuses on the 3 main factors: the widest selection, the lowest prices, and the best convenience. And they've done a great job over the years with innovation. So their growth driver, step number 2 in our process, is 8% penetration in e-commerce in the U.S. today. This is most likely going to double over the next decade. So here's a business with a nice tailwind with these strong competitive advantages. It also is selling at a very compelling price. If you look at Qualcomm, which is in our portfolio today, here's a company that for every single smartphone sold globally, they collect a 4% royalty of the price of that phone. So that to us is a very strong competitive advantage. And they have these royalties because they've got 10-year agreements in place with all the major handset manufacturers which want to utilize their standard for wireless technology. So that to us is repeatable, and the overall business is most likely going to do very well because the growth, smartphones most likely will triple in penetration over the coming decade. The turnover the last several years has been close to 20%. So we are clearly a buy and hold strategy. But the key is that paying the right price. That's the only thing you can control as an equity investor. That's why we do this 7-step research process, a month of work on one name, and buying at the bear or worst case value. Now, if you look at the average large cap mutual fund in the U.S., the average turnover is 80 to 100%, constantly turning the portfolio over. So we feel as though the 20% turnover gives us the conviction to let the companies compound and grow in value rather than constantly changing things around. The all-cap mandate gives us the ultimate flexibility. We can buy large-cap companies, mid-cap companies, and small-cap companies, as well as growth and value companies. So all sides of the box gives us the maximum flexibility. We could be 2/3 large and 1/3 small, or vice versa. So it truly is an exceptionally flexible strategy, going to where the opportunity is, making sure that at all times stocks are less than 70 cents on the dollar and selling them as they get up to 95, 100 cents. The Manulife U.S. all-cap portfolio is positioned with an overweight in technology, names like Qualcomm, Cisco Systems. These companies have strong competitive advantages. Consumer discretionary is an area we're looking at, And again, it's all a bottom-up process, but names such as Lowe's, Lennar, taking advantage of the housing recovery. Also, financials. This is an area that's very cheap to us. Companies such as JP Morgan, Bank of America, wide, globally diversified businesses selling at extremely attractive prices. We feel very positive going forward. Stocks are cheap versus their long-term history. If you look at the total return for the S&P 500 going back the last 100 years, it's been close to 10% total return per year. But the last decade has been fairly lackluster. Meanwhile, you've got a recovering U.S. economy, housing is getting better, banks are recapitalized. So if you look at the Manulife U.S. All-Cap Fund, this is a perfect way to take advantage of looking at U.S. equities from an investment perspective.